Today, the Downsizers Dilemma. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, as promised, I'm going to continue my occasional series on particular segments or types of households relating to property in Australia. And today I'm looking at those down traders. In other words, people who have a property which they're thinking of selling and potentially moving into somewhere smaller. Now, in current climate, this is a very tricky dilemma because, of course, over the last couple of years, we first saw home prices rocket higher, in some cases more than 30% above where they were previously. And now we're seeing property prices falling and beginning to fall quite fast. So the dilemma for down traders is this. Do you try and sell quickly to capitalize on some of that upside that you've seen recently? Or do you wait and see the next down cycle, which, by the way, could last something like 3 to 5 years before we start seeing prices climb again? Now, this is complex. This isn't also financial advice. This is just my general reflections on what I'm seeing. Now, in my surveys, there are more than 1 million households who are expecting to trade downwards, in other words, move to somewhere smaller over the next 1 to 2 years. And looking at the reasons why they're doing it, one of the main ones is to release equity and also to move somewhere smaller simply because it's too complex and difficult to maintain the property that they've currently got. Now, there are of course many factors to bear in mind here, but I thought I would give you my own case study because I am a down trader and I've been watching very closely property prices in Thurrool, where I have a house. And in fact, if you look at the trends data, you can see that prices peaked just over a year ago and have been sliding since then. And the property I've got is a very large one, much too large for me. Of course, I lost my wife last year. So I decided to sell the property. And in fact, I listed it on Boxing Day. And interestingly, I have now successfully made a sale. And in so doing, I have capitalized on the significant appreciation that we've seen over the past decade plus. And in fact, I've made more from the growth in the property compared with all the income that I've generated over the past decade, which is frankly just nuts. Now, of course, there's a couple of caveats here. Property prices are moving up and down differently in different parts of the country. Thurrool's original area near Wollongong, prices are actually falling quite quickly in these areas. In some other areas, maybe less so. But then, of course, the other part of the equation is, can you find somewhere to move to? Well, I've been quite fortunate. I have found a place that I wanted. In fact, it's a property that 20 years ago I'd have liked to have bought. So, in fact, I have actually purchased and was able to negotiate a lower purchase price, which more than offset the fall in the value I realised in the Thurrool sale. Now, another factor to bear in mind if you're a down trader, and particularly if you're over 55, is that there are specific arrangements that allows you to put a lump sum contribution into superannuation. And again, this isn't financial advice, but I'm just observing what the ATO says. So this is the information on the ATO site. And it says that if you've reached the eligible age, you may be able to contribute up to $300,000 from the proceeds of the sale or part sale of your home into your superannuation fund. The eligible ages are from 1 January 2023, 55 years old or older. Prior to that, it was 60 or 65 years. There is no maximum age limit, but there are some eligibility criteria that you must satisfy. Firstly, the home must be in Australia and have been owned by you or your spouse for at least 10 years, and the disposal must be exempt or partially exempt from capital gains tax. In other words, you can't do this with an investment property. You have not previously made a downsizer contribution to your super from the sale of another home or from the part sale of your home, and prior to or at the same time as making your contribution, you must provide your fund with a downsizer contribution into super form. Now, the ATO does actually provide more advice in a downloadable PDF, which steps through the process in a bit more detail. And it's also worth underscoring one critical thing. You have 90 days from the transaction to move the money into superannuation, or you'll miss the opportunity unless you've specifically sought an extension. There are some circumstances when they might give it. So it is worth reading through the copious materials that is available on the ATO site. I'll put a link in the comments below. And here is the downsizer contribution into superannuation form, which is pretty straightforward. You have to give information about your super fund, your own personal details, and the contribution, and then make a declaration. Now, this is an important opportunity, I think, particularly for those who may not have sufficient in superannuation. And of course, superannuation tends to be quite tax effective, but again, you would need specific financial advice. I can't give that. But it is really based now on three critical questions for downsizers. Should you sell quickly? If you can sell, is it worth taking a slight hit to still get equity out of the property? Or will you go through the next few years and then do something later? Or will you be forced to sell, perhaps at a time not of your choosing, due to health issues or other factors? That's pretty important to consider. The second question, though, is can you find a property to move to? And of course, supply of property, particularly at the moment, is pretty limited. Listings are quite way down, and a lot of the properties that are on market have been around for some time, are quite often old investment properties and need a lot of work. And in the current environment where the cost of work is pretty difficult and finding labour is pretty difficult, so there are a number of uncertainties. And of course, it's also worth remembering that depending on where you are in the country, you may well have to pay stamp duty and other fees if you purchase again. There's another thought too, and that is, well, is it more economic therefore to stay put and perhaps reconfigure the existing property to offer part of it as a rental property? Well, that may be worth considering too, but there are complexities there. So given the fact that interest rates are rising, given the fact that property prices are falling, given the fact that many downsizers are sitting on sizable equity pools at the moment, this is a very complex time to try and make a decision. So my thought process in my case was to find out what the property was currently worth and look at the recent trends, consider what an alternative property might look like and to see whether I could get one, and then if I can, do the maths to see whether it makes sense, and also consider the downsizer proposition with regard to money into superannuation. So there's a degree of complexity here, but I'm not sure that at the moment downsizers should be setting and forgetting and hoping that property prices are going to magically continue to rise. I fear that over the next 2 or 3 years, property prices are more likely to fall. As I showed in my recent surveys and modelling, my scenarios suggest quite considerable falls, and given that now we are expecting interest rates to rise higher than perhaps a few weeks ago, the falls could be more deep and longer. So it is indeed a downsizer's dilemma. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.